Liquidity is a superpower in the financial world. It's the ability to transform your assets into cold, hard cash. But what does it really mean, and why is it so important? From understanding liquid assets to why some stocks are more liquid than others, stay tuned as we unravel the mysteries of liquidity and discover how it can make or break your financial success. Let's start with why liquidity is a pretty important concept. If you've got an incredible family heirloom valued at a mind-blowing amount, then finding a buyer willing to pay anywhere close to its appraisal is like finding a needle in a haystack. That's where liquidity swoops in to save the day. Liquidity matters because it means that you can sell your asset without any hassle or loss, getting their full value in return. So what are these magical liquid assets that we're talking about? Well, at the top of the food chain, we've got cash, the ultimate liquid champion. It's the real deal. But wait, there's more. We also have cash equivalents like money market accounts and certificates of deposit that can be easily converted to cash. And let's not forget about those tradable securities such as stocks and bonds listed on exchanges. They can be turned into cash pretty quickly. Oh, and did I mention that even gold coins and certain collectibles can give you a quick cash injection? It's like turning your treasures into spending power. But hold your horses, because not all assets are created equal when it comes to liquidity. Selling a home, a timeshare, or a car? Buckle up for a bumpy ride. It can take weeks, months, or even longer to find a buyer and close the deal. And don't get me started on those sneaky broker fees that can take a bite out of your hard-earned profits. But wait, it's about more than just the liquidity of your family heirloom. Asset liquidity is totally different from market liquidity. Imagine a bustling stock market where assets are bought and sold at stable and transparent prices. That's what we call a high market liquidity. But if the market lacks trading activity, it becomes more illiquid. For example, that rare book collector who wants to trade their collection for a refrigerator? Well, that market practically doesn't exist. Accounting liquidity is another important aspect of it. It measures how easily an individual or a company can meet their financial obligations using their liquid assets. Think of it as your ability to pay off debts when they come knocking. You don't want to be caught in a tight spot without enough liquid assets. Analysts and investors use some handy ratios to measure liquidity and get a sense of a company's financial strength. These ratios act as our trusted guides, revealing the company's ability to handle its short-term obligations and stay afloat. Let's start with a current ratio, a friendly ratio that's simple and not too picky. It compares the value of a company's current assets, the ones it can quickly turn to cash within a year, to its current liabilities. It's as easy as dividing current assets by current liabilities. Boom! Current ratio is equal to current assets divided by current liabilities. Next up, we have the quick ratio, also known as the acid test ratio. It's a bit stricter. This ratio excludes inventories and other assets that aren't so easy to convert to cash. Instead, it focuses on cash and cash equivalents, accounts receivable, and short-term investments. Get ready for some math magic! Quick ratio is equal to cash and cash equivalents plus short-term investments plus accounts receivables, whole divided by current liabilities. Now, let's meet the acid test ratio variation, a cool cousin of the quick ratio. It's a bit more generous because it subtracts inventory from current assets. Here's the deal. Acid test ratio variation is equal to current assets minus inventories minus prepaid costs, whole divided by current liabilities. Finally, we have the cash ratio, the toughest of them all. It's like the ultimate test of a company's liquidity skills. This ratio only considers the most liquid assets, that's cash or cash equivalents. It excludes accounts receivable and any other current assets. The cash ratio gives us a crystal clear picture of how financially stable a company is during emergencies. Even the most profitable companies can face trouble if they don't have enough cash on hand to handle unexpected events. Here's the formula for the cash ratio. Cash ratio is equal to cash and cash equivalents divided by current liabilities. These ratios help us understand how well a company can meet its short-term obligations using its available liquid assets. In general, it's a good sign if the ratio is greater than 1 when using these formulas. So keep your eyes peeled for these ratios to assess a company's liability and its ability to navigate stormy waters and unexpected challenges. Alright, my financial enthusiasts, let's dive into the fascinating world of liquidity and stocks. Not all equities are created equal when it comes to liquidity. Some stocks are like the life of the party, with lots of people interested in buying and selling them, while others are a bit shy and attract less attention. The liquid stocks are the popular kids on the block. They have a high daily trading volume, often in the millions or even hundreds of millions of shares. This means there's a bustling market with many buyers and sellers, making it easy for investors to buy or sell these stocks without rocking the boat too much in terms of price. On the other hand, though, low-volume stocks may be a bit harder to trade since there are fewer market participants and less liquidity in the mix. When we talk about liquidity, Tesla is definitely in the spotlight. This stock's been a hot topic in the financial world, attracting a massive amount of interest and trading volume. On any given day, you'll find millions of shares being bought and sold, creating a highly liquid market for Tesla stock. For instance, on a recent trading day, let's say 50 million shares of Tesla were traded. This high trading volume indicates a vibrant market with numerous buyers and sellers actively participating. Investors who own Tesla stock can easily sell their shares without causing significant price fluctuations or facing difficulties finding buyers. One example of an illiquid stock from the stock market is a small, relatively unknown company with low trading volume. These stocks typically have fewer buyers and sellers, resulting in limited market activity. Due to their illiquidity, it can be challenging to buy or sell these stocks at desired prices without significantly impacting their market value. It's not just stocks that make a difference. When there is a liquid market with many buyers and sellers, it becomes easier to determine the fair market value of assets or securities. Prices tend to reflect all available information more accurately, reducing the chances of mispricing or market manipulation. Moreover, liquidity can attract more market participants and increase market depth. This, in turn, encourages competition and enhances market resilience. It provides more opportunities for investors to enter or exit positions with relative ease, reducing transaction costs and increasing market accessibility. But why are some stocks more liquid than others? It all comes down to the level of interest from market participants and the daily transaction volume. The most liquid stocks are like magnets, attracting many market actors and market makers who maintain a tight market with lots of buyers and sellers. Illiquid stocks have wider bid-ask spreads and less market depth. They tend to be lesser known, with lower trading volume, market value, and volatility. So a big multinational bank's stock will usually be more liquid than that of a small regional bank. Now let's address an important distinction: liquidity versus solvency. While liquidity refers to the ease of converting assets into cash, solvency looks at the ability to meet long-term financial obligations. Liquidity ensures that you can cover short-term debts and obligations, whereas solvency ensures that you can handle long-term financial stability. In general, it's crucial to strike a balance between liquidity and solvency. Having sufficient liquidity ensures day-to-day financial operations can be smoothly conducted, while maintaining solvency ensures the ability to meet all financial obligations in the long run. Neglecting either aspect can lead to financial difficulties. So it's essential to manage both liquidity and solvency effectively to maintain a healthy financial position. Having liquidity is crucial for you because it allows you to access cash quickly and navigate unexpected expenses or financial emergencies. To boost liquidity, it's important to maintain a cash cushion by setting aside an emergency fund. Diversifying investments between liquid assets like stocks and bonds, along with cash equivalents, provides options for converting investments into cash if needed. Minimizing illiquid assets and managing debt wisely are also key strategies to enhance liquidity. Also, building a strong credit history ensures access to credit options during times when liquidity is required. By striking a balance between liquid and illiquid assets, you can maintain financial stability, flexibility, and a peace of mind in uncertain times. So, from understanding why some stocks are more liquid than others, to how liquidity as a whole is relevant in our daily lives, that's all for demystifying this elusive concept.